Today was the largest red day for the S&P 500 since September 21st, 2023. Today was the FOMC press conference in which we learned we're probably not getting our first rate cut in March. Now, what historically happens if we have a bearish Fed Jerome Powell? Well, I annualized data over the past 4 bearish Fed meetings, and I'll share that with you in this video. We also got some breaking news out of Tesla after the bell today that I think is pretty impactful, which could be the reason why Tesla stock is up about 0.5% here in after hours. After the bell today, we also got some good news potentially about Apple's earnings. Tesla also had over $2 billion worth of hedge fund and institutional option activity today. Was it bearish? Was it bullish? I'll share that with you as well. So, if you can't tell, we have a lot to get into in a very short amount of time. Hit that like button and consider subscribing to the channel if you want to stay up to date with everything going on in our markets and Tesla stock more specifically each and every single day. In fact, not just once a day, but twice a day, once at 4 p.m. and once at 8 p.m., 365 days a year. So the big story today, and the reason why stocks had the worst day since September 21st, 2023, coincidentally, the last bearish Fed meeting we had, is because of this. Fed Jerome Powell does not plan on cutting rates in March. You would have to see inflation come down aggressively and or the economy weaken quite a bit from now until March. If that does not happen, we're not getting a rate cut in March. Now, there were other things that were said as well, some of which were really good for markets that I don't think markets fully appreciated. Remember this narrative that is somewhat starting to go away now, where we need to see unemployment rise. We need to see the economy get worse from here in order to see rate cuts. The Fed said that is not true. The Fed said quite the opposite. The Fed said they want to see the economy doing well. They want to see GDP at 5%. They want to see people continue to have jobs as long as inflation continues to fall and does not rise from here. Fed Jerome Powell also said that it's a lot more likely that inflation comes down to 2% and kind of just holds above 2% rather than spikes larger from here. And that's the real reason why they're not in a super big rush to start cutting rates. Fed Jerome Powell also threw a bone to the bond market, and that's why treasuries fell today and stocks fell today. I should say more specifically, treasuries rose, treasury yields fell. Normally, you see when yields fall, stocks do well, but that actually did not happen today. So I think there's something a little bit deeper going on in our markets. Fed Jerome Powell said they're going to have long discussions coming at the next Fed meeting in March about reducing the pace of their balance sheet runoff or potentially even stopping that altogether. That will indeed put less selling pressure on TLT. Less selling pressure on TLT means TLT is likely to rise, thus yields likely to fall. And that's why 10-year treasury yields fell over 14 basis points today and probably going to continue to fall over the next couple of days or so. If markets take that as good news, I think is something to watch pretty closely. We have seen a pretty direct correlation lately to yields falling and stocks rising. Yields going higher on, let's say, your 10-year treasury, and stocks going lower. That's because most of the borrowing that happens in the economy does not happen based on where the Fed sets federal fund rates, but where 10-year treasury yields are trading at. Your mortgage, that trades off 10-year treasuries. An auto loan, that trades off of 10-year treasuries. Credit cards, that trades off of, you guessed it, 10-year treasury yields. So treasuries actually falling today is great for the economy. It will be great inevitably for stocks, but when? So as I previously mentioned, this was the worst day since September 21st, 2023. And coincidentally, that was the last bearish FOMC meeting that we got. That was right here. Stocks actually fell September 20th, about 1% or so. And then the day of the Fed meeting and Jerome Powell himself, stocks fell 1.65%. The day after that, they fell about 1/4%, up a little bit, and then down another 1.5%. This was a big drop this day, but you kind of regain that. And then you continue to fall over the next couple of days. So this data that I annualize, I'm basically going from the Fed, from the FOMC, until you hit the low and you start to spike again in a meaningful way. You start to recover and start to rise. So I would do this from here down to here. That's essentially what I'm looking at. The drawdown over the next week or two following the Fed. What I found is it's usually not that bad. Now that's relative because these numbers can look quite large. So September 20th, the last bearish Fed that we've seen, and keep in mind, I'm only looking at the last 12 months of bearish Fed reactions. So a lot of Fed meetings have been bullish. We're only looking at the bearish ones because it's clear markets took today as bearish. So September 20th, that was a drawdown of 5.4%. July 26th, over the next, again, week or two following the Fed, was a drawdown of 5.7%. May 3rd was a drawdown of 3.31%. And March 22nd was a drawdown of 3.13%. So if you average all of this out, you tend to see a drop of about 4.38%. Considering the S&P 500 fell 1.63% today, you could make the argument you could be almost halfway through a typical bearish Fed correction event. What makes this time a little bit trickier is we're going to have big economic data on Friday, which is non-farm payrolls and the unemployment rate. I would imagine we want to see those numbers come in good now because the Fed said that's okay. We are also going to have Apple, Amazon, and Meta earnings tomorrow. And we actually got some good news for Apple here in after hours. Apple stock is up 0.3%. It was up almost 1% right after the closing bell today. That is because Qualcomm beat estimates as smartphone chip sales suggest recovery. Now, Qualcomm is an independent company, but they do a lot of their business with Apple. Around 20% of all of Qualcomm's business, $44 billion in revenue last year, was to Apple. So if Qualcomm has good earnings, probably Apple will as well. Now, the interesting part about this is Qualcomm's EPS beat by a long shot by about 40 cents. Revenue beat as well by almost $500 million, $500 million. But this part is probably why Qualcomm is not doing that well in after hours. They say for the current quarter, Qualcomm said it expects adjusted earnings of between $1.73 and $1.93 per share on revenue of $8.9 billion to $9.7 billion. Consensus expectations, according to LSEG, were for earnings of $2.25 per share. So that is definitely on the high side, right? The guidance was nowhere even close to that. It wasn't even, $2 or more. The highest end range of the guidance was $1.93. And $9.3 billion in revenue is, on the low side, that would be quite a big miss. Qualcomm's guidance of $8.9 billion. On the high side, that would be quite a big beat at $9.7 billion. So we really didn't get much as far as definitive good guidance, but it's a good sign that maybe if things go well, Qualcomm could beat, which could mean Apple could beat, maybe provide a little bit better guidance than they have over the past couple of quarters as well. Apple is about 7% of the S&P 500, so their earnings tomorrow are definitely going to matter. And here is your earnings calendar. You could see Apple, Amazon, and Meta tomorrow and after hours. Those are going to be the last of your $1 trillion+ companies, besides Nvidia, which will report in about 2.5 weeks from now. So these earnings could set the tone over the next couple of weeks for our markets. I will also provide an earnings preview towards the end of this video for Apple, Amazon, and Meta, and really what the markets are expecting out of those companies, and whether or not I think the earnings are going to be good and if the stocks are going to continue higher. But first, we have some breaking news for Tesla, and again, probably the reason why Tesla is outperforming other large tech names in after hours. Tesla will reportedly expand battery production in Nevada, opening a small facility using idle equipment from China's CATL. Tesla will have full control of the facility and cover 100% of the cost, and CATL personnel will be uninvolved other than helping to set up the equipment. The plant, which will make cells for Tesla's large battery Megapack product, is part of a broader effort to onshore the supply chain for lithium iron phosphate cells in America. Tesla also sees the equipment purchase arrangement as a cost-effective way to set up new facilities. Bloomberg says initially the plant will have a limited output, around 10 gigawatt hours, the people said familiar with the matter, and be expanded if the project goes smoothly and the supply chain can be established. The facility likely won't be operational until 2025. It could eventually account for about 20% of Tesla's battery production in the region, including the Lathrop location. So by the time this thing gets scaled, if everything goes smooth by 2026, 2027, this facility could be putting out massive numbers of new batteries. And let's be honest, if we want Tesla to keep growing deliveries, they gotta keep growing production of, you guessed it, batteries. So this is another fundamentally important stepping stone for Tesla's higher growth, which hopefully comes in 2025 and then more indefinitely in 2026. But again, without batteries, you have nothing. And if we want energy, like Megapacks, to continue to become a larger portion of Tesla's business, continue to see that grow at 50% growth rates, you definitely need to see more battery facilities. And I do think Wall Street likes Tesla investing in Megapacks, energy storage, considering that is the fastest growing part of Tesla's business right now. Tesla's option activity from hedge fund and institutional investors today was about $2.15 billion. Now, you had 806 orders with a positive order value of 42%. So it was not that great, but a lot of the bearish activity in Tesla in our markets came in after Fed Jerome Powell. There's a lot of people that were actually pretty bullish under the surface before Powell spoke. Now, this makes sense given how bearish Jerome Powell could have been, and markets were pricing in great things from Powell, really an overall perfect storm scenario. As you can see here, the MOC imbalance by the end of the day was $7.2 billion to the sell side. If you are unfamiliar with MOC, this is a very popular term. It stands for market on close imbalance. It basically shows you out of the order book and what is trying to get filled and executed by the end of the day. Exactly that. There was $7.2 billion more to the sell side than to the buy side. That typically does cause a pretty violent up or down move by the end of the day. That's why you might see at 3:50 sharp PM every day, you tend to get a pretty large move up or down. Now, Jeffrey Gunlock says all the Goldilocks talk makes him nervous. He thinks a recession is still likely. Gunlock believes the market's faith was blindly optimistic and that Powell's message on Wednesday crushed the Goldilocks theory. Quote, "For now, we think there will be a stall in the inflation rate coming down," Gunlock said. "That will probably mean the market is not going to get the Goldilocks picture that it was euphoric about a couple of weeks ago." He says, "I think you want cash to be able to get into emerging market trades once the economy slows and perhaps go into a recession. Globally, there are certainly many pockets of recessions at present. If we go into the United States recession, I think we will see a buying opportunity, and you want cash for that." Overall, this guy, you probably have seen him before. We've talked about him before on the channel. He thinks today's Fed meeting crushed the Goldilocks scenario, that the Fed may take way longer to start cutting rates than what we're expecting. It's really going to come down to the data ultimately, but if inflation kind of stalls out here like we seen last month, inflation actually went up on a month-over-month basis, and the economy does not weaken, yeah, we're not getting rate cuts anytime soon. The Fed's not going to be in a hurry to make a mistake. The Fed made it clear today they want to be 100% convinced inflation is headed back to 2%. And or convinced the economy is heading into a downturn, which that looks seems a lot less likely than inflation going all the way down to 2% at this point. And coming on Friday, we are going to get the non-farm payroll report. Goldman Sachs believes we could come in at 250,000 job ads, which is about 70,000 higher than expected. And if that were to happen, stocks could puke a little bit further from here, as it would really look like the first rate cut's probably not going to happen until June, if not potentially even into the third quarter of 2024. This, I don't think, is overall a problem. If the economy can handle higher rates, then theoretically that shouldn't affect stocks too much. That does keep cash in bonds, which can affect valuations. But overall, I think this is a bigger problem because stocks are at all-time highs, or at least they were before Fed Jerome Powell started speaking. That's why I think we could get a larger downturn. It's more so because markets were just expecting really good news. This Goldilocks scenario, if you will. And honestly, I would not be surprised if we saw a reset back to your prior all-time high, which was set on January 4th of 2022 at about 465 on the SPY. This is obviously not going to happen in a single day. This would be a drawdown from here of roughly about 3.65%, but nonetheless, I'm not expecting a crash. I'm not expecting this to be the short-term bottom either. I'm a little bit more positive on a stock like a Tesla because Tesla's already seen the beatdown in 2024. But I guess it really depends on what Apple and Amazon and some of these other names say tomorrow, and then ultimately what the data looks like on Friday. Tomorrow, the only data that we are really going to get that is impactful to markets is ISM manufacturing PMI. A lot of your Fed presidents and a lot of your... The only data that we're really going to get tomorrow that will be impactful for markets is your ISM manufacturing PMI. Now, a lot of the manufacturing surveys we have seen from your Fed banks have been really bad. Dallas Fed, Kansas Fed, New York Empire State Fed, Atlanta Fed, Chicago Fed. They've all been very, very, very negative. If ISM says the same thing, may not be good for stocks, or it could be positive for stocks, as maybe that would mean the Fed has a reason to cut rates sooner. Expectations are the ISM manufacturing PMI will come in at 47. Last month you were at 47.4. That wouldn't surprise me, but kind of considering the steep declines we've seen in some of your other manufacturing surveys and indexes, I mean, this thing could really fall coming tomorrow. For Apple's earnings preview, Wall Street is expecting Apple to report earnings per share of $2.11 on revenue of $117.9 billion, according to estimates compiled by Bloomberg. That would mark an increase from last year when Apple reported EPS of $1.88 on revenue of $117.2 billion. Now, Apple has seen 4 quarters of declining year-over-year revenue, so if Apple misses the mark here, that's going to be the 5th straight quarter, and that would not be good news. North America and Europe is expected to fall from $23.9 billion to $23.5 billion. Analysts say resurgent Huawei, which is selling high-end smartphones that rival Apple's, and China's faltering economic recovery are cutting into Apple's sales in the region. iPhone revenue is expected to come in at $68.6 billion, which would be a setup from the same period last year when Apple reported iPhone revenue of $65.78 billion. Apple's Mac revenue also appears set for a slight recovery, with analysts anticipating sales of $7.9 billion in the quarter versus $7.7 billion in the same quarter of last year. iPad revenue is expected to drop more than $2 billion to $7.06 billion compared to $9.4 billion last year. Apple's service segment is expected to have the largest increase, and you're expecting sales of $23.4 billion, up from $20.8 billion last year. This is probably what is going to move Apple stock. Obviously, it's going to be the commentary around China, around competition, and what kind of the outlook looks like for 2024. Keep in mind, Apple has not provided official guidance since 2020. We've seen what happened when Tesla did not provide guidance, but it's okay when Apple apparently does not provide guidance for many years. So we want to hear their tone. They'll give you kind of overview of what they're looking at, how the business is doing, but they're not going to give you official numbers. Services will be a big one though. If that misses, Apple's not going to do well. We also want to hear how successful early sales have been on the new Apple headset, which retails for about $3,500. And last but not least, wearables, home, and accessories should generate revenue of $12 billion in the quarter, down from $13.5 billion in Q1 of last year. So a decline in wearables, a decline in iPad, a slight year-over-year gain in Mac. iPhone is expected to be better as well than last year, but really iPhone and service numbers, those are really the only ones that are expected to be substantially higher on a year-over-year basis. If any of those two miss, that's where you get the downside in Apple. Amazon. Analysts are expecting to see an explosive jump in earnings compared to a year ago as Amazon's cost-cutting efforts begin to pay off. Wall Street is looking for earnings of 80 cents per share in the most recent quarter versus 3 cents a share a year ago. It also is expecting revenues of $166 billion in the most recent quarter, about $17 billion more than the same period a year ago. And bulls like to point out that Amazon has so far beaten both earnings and revenue estimates every quarter of the last fiscal year. Advertising revenue and Amazon Web Services, two major growth areas for the company, will continue to be key areas of focus for investors, as will online retail sales, especially as these numbers will be from the holiday quarter. And really, it's all about Amazon Web Services. Now, Bernstein today says, quote, "This might be a stretch, but we will know more on Thursday when Amazon reports. Microsoft Azure," their cloud services, the only thing people really care about when it comes to Microsoft, grew 28% year on year in Q2, but 6 points of that growth was due to AI, up from just 3 points in Q1. Thus, one could argue that non-AI Azure growth is slowing down, which bodes relatively poorly for other cloud consumption companies like Amazon. So if Amazon misses on Amazon Web Services, yeah, that's where the downside will come from in Amazon. And for Meta shares increased by 194% in 2023 as the company cut costs and employees and saw user growth and higher engagement. So investors are expecting big things from the earnings this week. Consensus among analysts calls for earnings of $4.93 per share in the most recent quarter versus $1.76 a share ago and revenues of just over $39 billion. Meta's AI efforts will be an area of extreme interest for investors, as will China, which is a growing source of revenue for the company. So overall, Amazon and Meta, they have high expectations tomorrow as far as year-over-year growth, as far as obviously the AI, right, from Meta and Amazon. Overall EPS, all of it's high. The expectations are very high for Amazon and Meta. Apple's expectations are a little bit on the lower side, but based on Qualcomm's earnings today and after hours, as we previously mentioned, suggesting that unit volumes could be getting better in 2024, or at least to start for Q1 2024, that may raise the bar a little bit heading into Apple earnings as well. Overall, I think potentially Amazon is set up for disappointment. Apple's probably going to walk the fine line. And Meta could go really either way. I'm leaning more bearish than not, considering Meta has went up big time. It's basically been straight up for the better part of about 2 years now. Now, I will be trading these earnings coming tomorrow. I have a specific strategy that I like to employ. If you guys want to come see that strategy, come trade with us live in real time. Every time that we make trades, I send out alerts. Every time I specifically make trades, a lot of people post their trades as well. This does take me back, though, with Meta. I had 5 free contracts. I had 0 principal risk on this trade back in February of 2022. 5 of them for free. I sold out at 3:59 p.m. to collect, it was like $500 in profit. So it was still a profitable trade. I would have made $25,000 if I held those trades though. Yeah, so we're employing that strategy all the time, hitting big monster home runs. Check that out. Again, link down below in the description if you guys want to be a part of it. Thank you for watching. Enjoy the rest of your day. My name is Michael Tyler, and I will see you in the next one.